Welcome back. Now at the half-year mark, Vukile Property Fund's top line grew by 5.8%, while headline earnings per share increased by 5.3%. The retail landlord attributes the earnings to solid trading metrics in South Africa and Spain, and at a 6% rise. The group boasts one of the highest dividend payouts among the top REITs listed on the local bourse. Company CEO Laurence Rapp joins us with a closer look at the building blocks underpinning the performance. Thank you so much for your time, Laurence. Let's actually start off there at the top, because you speak about a half year that was a tale of two quarters. Talk to me about the drivers that were behind the kind of differences that we saw in the quarters.
So, Nadi, thank you very much. And I think that comment is very much applicable to South Africa, not the Spanish business.
Yes, yes.
We certainly saw, the first quarter, a lot of uncertainty from the consumer. Remember, that was pre-elections. I think a lot of optimism around load shedding ending, but not real confidence that it was going to happen. And I think by the time we got to the second quarter, post-elections, I think a lot of enthusiasm from consumers, the market generally, and also sort of more sustained results on the end of load shedding. So I think that really contributed to a stronger second quarter than the first quarter, and largely driven, I guess, by macro sentiment, interest rate cycles starting to turn and so on. So that sort of is really where that came through in the SA business. Spain was sort of really strong throughout, no real difference first to second quarter.
Yeah, and really just sticking to South Africa, I mean, considering the fundamentals that do exist, because, I mean, as much as there is this positive sentiment, we haven't really seen that filtering through to economic growth. And of course, with property companies, you always look at the rental reversions that kind of tell a tale of how your tenants are feeling. So you have experienced upward momentum, but what level of momentum are you seeing there with those rental reversions in South Africa?
Exactly. I think that's spot on. That's always a very good indication as to how, the retailers are looking going forward. And I think we need to point to a few things. We've had, a few reporting periods of positive rental reversions, which already is very positive. When we look at this last 6 months, 85% of the leases reverted positively or flat, which shows you a very strong degree of enthusiasm. There are always going to be some leases that will go backwards. On average, we saw a 1.6% increase in reversions. And that, in fact, was really pulled down only by 2 leases. If we exclude those 2 leases, the actual broader portfolio was up by around 3.3%. So we're sort of seeing very positive momentum. In addition to that, we're seeing that the length of leases is increasing. So our current WALE is sitting at around 3.5 years. The WALE on new deals is sitting at 3.8 years, indicating that tenants are more confident, not only prepared to pay higher rents, but sign longer leases. So really, it is a more positive and upbeat environment that we're seeing at the moment.
All right. Laurence, we are in a lower interest rate cycle, and also we have the two-pot system coming in, of course, all those affecting the consumer directly. But I'm just wondering, what kind of growth are you expecting, firstly, with the interest rates, considering, yes, we are in a cutting cycle, but we've had quite hawkish tones coming from the Fed and the South African Reserve Bank. And then also, actually, let's start off there. I'll come back to the two-pot system.
Right. Look, I think, certainly the impact of lower interest rates generally takes around 12 months to filter through into actual trading stats. So I think at the moment, the lower interest rates are probably more working in our favor as a sector in terms of making the REIT sector more interesting, as opposed to necessarily seeing that benefit coming through in trading. It certainly drives sentiment, and sentiment always sort of moves more quickly. But actual, additional rands or euros in the customer's pocket, that's probably only going to start filtering through in a year or so's time. And I think that does augur well, for us overall. Maybe to preempt your question, I think there are some other drivers. Obviously, the two-pot system, I think we're going to see as being sort of a real boon to consumer spending in South Africa. And on the Spanish side, we really are seeing a very strong consumer with lower levels of debt than they've had historically, higher levels of saving. And I think it's sort of those factors that are sort of giving us the confidence as to where the business is headed going forward, because we really are seeing particular strength in the underlying consumer environment. And we believe that that sort of will last, for a good few years going forward.
Well, actually, talking about Spain, there are some funds that are expected to flow in from the Castellana's, the sale of its investment in La España. And I'm wondering what the priorities in terms of use of that cash flow you will be focusing on.
Sure. So the idea in selling LA was also to be able to redeploy that money quickly into physical assets that we believe we could get hold of at very attractive pricing. We do have an asset that's earmarked for this money. In fact, we were due to buy the asset, and then it got affected by the tragic floods in Valencia. So we have postponed the transaction. It still remains under exclusivity for us. Fortunately, the news flow is more positive than we expected in terms of the time it will take to reinstate the center. And I think it's still very much our intention to redeploy that LA money into the new asset, hopefully still in this financial year, and looking, to the very beginning of 2025 to get that done.
And of course, in your geographical diversification effort, you've expanded your footprint to Portugal. Why that market? And would there still be more room for acquisitions there?
Absolutely. It was very much the logical market for Castellana to expand into. Obviously, geographic proximity being next door. We like the macroeconomic picture, good growth of around 2% in GDP, strong tourism market, very strong shopping center culture in Portugal, and exhibits very many of the same criteria and aspects that we see in the Spanish market of often getting undermanaged centers, quite a fragmented market, and opportunities. So we've started off by buying a portfolio of 3 assets for 176 million. That's on a very attractive yield of 9.25 in euros. And yes, we do have another 2 deals that we currently are actively evaluating and a good pipeline. So we do see further growth coming in Portugal. Importantly, our team has got experience in working there, a very strong overlap, about 80% commonality between the tenants in Portugal and Spain. So we've got deep relationships to leverage as well. So it was the natural expansion, and we believe that there is some good growth coming in Portugal as well.
All right. Well, we do have to end the conversation there, Laurence. Thank you very much for giving us insight into the numbers that we saw coming out of Vukile. That was Laurence Rapp, CEO of Vukile Property Fund.